Welcome everybody to the bonus module for line of credit. Now in this module, this is a standalone module, and we're just going over lines of credit and some of the particulars that you need to consider when you're taking out a line of credit. First, we'll go over how much do you really need. We've talked about in the other modules that you need to consider having a line of credit, especially if you don't need one right now. You need to consider about getting one, and we're going to go over how much do you need to have in that line of credit. Do you need 20,000, 30,000, 100,000? What is your actual monetary needs in there? And then we're going to go over some of the other uniqueness about the lines of credit, and in particular we're going to go over the financial covenants and other covenants in a line of credit. That's where a lot of people wind up in trouble because they don't know all the particulars that are in their line of credit. So we're going to jump in and we're going to take a look at this. And again, on the template that we're going to go over to determine how much you need, this is just a general idea. You don't have to necessarily go through all these particular steps, but I'm going to show you how the calculation can be done so you can get kind of a firm grasp on the number that you'll need. But again, this is just a general way to calculate that. So let's go ahead and jump into the module. So welcome everybody to the bonus module for the line of credit. Again, as I indicated in the intro, we're going to go through a lot of the particulars in the line of credit to first help you understand what you need to have in your line of credit dollar-wise, and then what are some of the nuances within a line of credit that cause people to sometimes get into trouble. So we're going to review, obviously, determine your needs, the different offerings that are out there, interest rates and renewal dates, covenants. Again, that's going to be the big item. Most of the covenants in your line of credit are going to be financial related, but there are some non-financial related ones that I'm going to highlight to you, and if you have them and you can identify them, you can save yourself some money on the back end within your line of credit. Payment terms, and then drawings, resting, and fees within a line of credit. So first thing, how to determine your needs. Your line of credit really should be used when your cash is tied up in other assets. So by that, the easiest explanation on that is when you have a bunch of accounts receivable, people who owe you money but they haven't paid you yet. So you have cash sitting there, it's tied up, and you just can't access it because they haven't paid you. So that's what you want to consider there. Also, if you happen to be in a business where you have to purchase inventory for, from a foreign country, and the shipping time between, placing the order and it arriving at your particular warehouse can be 4, 5, 6 months, a lot of times you're going to have to buy a lot of extra inventory. Well, remember when we talked about inventory in the module 3? That's really cash that's just tied up in another asset. So again, that's more cash that's tied up. And so lines of credit really should be used when your cash from your operations is just tied up somewhere else, and it's merely a timing issue between when you're going to get paid and when you actually need the cash. And so that's one of the things you need to remember on a line of credit. Now, I know you probably just saw me bring this up and your head just spun with all this verbiage and technical data, but I'm going to go over a template on this, and it'll make more sense. I just wanted to show this first part to you so you can see it and hear it, and then when we go through the template, hopefully it'll start making more sense. So the best way to determine what your needs are is you want to calculate your sales per day. In other words, how much sales, and in this example, we use 365. Clearly that's assuming you're going to be open 365 days a year, which you're probably not. So you can adjust that 365 number to however many days you're going to be open. But for the most part, most people just use 365 because it just makes it easier, because you're going to use that number on a lot of your other calcs, such as your AR turnover and your inventory turnover. So first, calculate your sales per day, and then calculate your days in sales of accounts receivable, inventory, and AP. Now remember, we went and we did that calculation in module 3 in sessions 1, but just recall the calculation on the AR is we're calculating that the amount of sales that are sitting in your accounts receivable. What is that? The amount of days in your inventory and the amount of days in AP. Now, we didn't really necessarily hit AP too much, but it's really the same concept as your inventory calculation. So it's just, instead of using your inventory number, you're going to be using your accounts payable number. Then you take those total days, So your total days of AR, so let's say it's 10. Total days in AP, let's say, or I mean in inventory, let's say it's another 10, so we're up to 20. And then less the days in AP, let's say it's 5, so that equals 15 days. And so you then take that number, multiply it by your sales per day, and that's how you ultimately calculate the amount that you're going to need for a line of credit. Now, remember, when we do this calculation, you want to round. Don't put an exact number. I would always round up to the nearest thousand. It just makes life easier. And maybe add a little bit on there because you may have a weird skew in your particular calculation. So let's go ahead and take a look at the template now. Now that we've kind of just went over briefly this, I'm going to now walk you through the template, so this will start to make more sense. So here's our template, and again, this is supplied with your materials, so you can go ahead and jump in and use this as we go through this, but I'm going to show you how this works. Now remember, on that that slide we just looked at, the total sales, first we want to calculate what's the daily cash need based on total sales. So in this example, we're going to assume sales are 545,000. And that comes out to a daily cash need of $14.93. And again, here's the formula, so we can see literally just taking this number divided by 365. Now we need to drop in how many days on hand do we have in AR. Now this is days sales on hand. So for our example purposes, let's say we have 25 days. So as you can see, it's already starting to calculate. If our inventory, we didn't have any, but let's say we don't have inventory and we have no AP, we would have a cash need of approximately $38,000 for a line of credit. Now, let's say we're a manufacturing company and we've got inventory, and inventory moves pretty good, but we still have inventory on hand. So let's say we have 48 days of inventory on hand. So you look at that. Now we've gone up to 109,000. Now, why did it jump so much? Well, the reason being is this inventory days on hand, again, that's cash. If you remember our journal entry, when we purchase inventory, we're crediting cash, or reducing cash, and we're debiting inventory. So we have 48 days worth of sales just sitting in inventory as of this balance sheet date. So that bumped up to 109,000. Now let's go ahead and put in our AP. So let's say we pay our accounts payable pretty darn quickly. We get the invoice in and we process it within 1 month. So let's just say we have 30 days worth of AP on hand. Now all of a sudden that balance went down. Now why is that? Well, if you think about when you purchase a product from a vendor and you have to pay for it, but you don't have to pay for it cash right away, that's technically you're getting the benefit of the product, you're getting benefit of the cash, and so that's why that reduces it. So again, let's take it out of there. So you'll look at it and you'll see $109,000 of what you need just based off of AR and inventory. Now, if we have products that we are ultimately selling, so we purchase a product and it's probably sitting in inventory, but we're going to delay paying it. So in this situation, we pay it within 30 days and averages. That means our cash that we need for a line of credit actually went down. So in this case, it's saying, based on these factors that we put in here, we need about a $65,000 line of credit. Now, again, like I mentioned, you probably want to bump this up, maybe bump it up to 70,000 or the nearest whole number, just to give you some cushion and leeway in there. But let's go ahead and see what happens as we manipulate these numbers, so you can kind of see cash flow instances and also how it affects the amount of line of credit you need. So let's say 25 days on hand in AR is pretty darn good. If you've never done the calculation, that's like superb. But let's say you are in an industry where it just, it's like pulling teeth to get them to pay. Let's say it's 45 days. That just bumped it up almost $30,000 that you're going to need to consider for your line of credit. Now, you can always do a capital call and not have to borrow from a line of credit. This is just to show you that based on these metrics, how much you probably want to have set aside or set up in your line of credit. So as you saw, 15 extra days in this situation added to almost $30,000 additional need of cash, because that's how much cash you have stuck in your accounts receivable. Now, let's say it goes to 60 days, so it takes 2 months for your clients to finally pay you. That bumped up to $116,000. So you see how that affects your cash flow and how you have to borrow. And this concept right here, just on the accounts receivable, let's go ahead and take these items out so you can kind of see this. So if we go back to 25 days, you have a 37, more or less what that's saying is you have $37,000 of cash tied up in your accounts receivable. If we go up to 45 days, you got 67,000. If we go up to 90 days, 60 days, you have 89,000, approximately $90,000 worth of cash tied up in AR. So as you see, remember back in Module 3 when we talked about accounts receivable, how you want to have a collection policy when accounts receivable hit a certain criteria, whether it's 30 days, 35 days, 45 days, whatever it is, to work those accounts receivable, get in. Because if you don't, that's how much cash you have based on your sales you have just sitting in your accounts receivable. So if you walk through this process, let's say that's your only metric that you have to put in here. So we're saying approximately $90,000. If you're pulling a $90,000 off of your line of credit because you're waiting to get paid on your accounts receivable, well, what's going to happen on your side? You're going to end up having to pay interest. So think about that, is indirectly you're giving them the benefit of interest. And that's why in your accounts receivable collection policy, you want to make sure you set up some sort of interest calculation, such as, if your account, your customer account is late, after 30 days or 45 days, you're going to start charging them interest. That's because you're not necessarily trying to, quote, make money. You're trying to make it so you're not out money when you're pulling on your line of credit. And a lot of accounting softwares, I didn't go over this when I talked about the accounting softwares, but a lot of accounting softwares will allow you the option to set up a interest rate and when to start charging interest on accounts receivable. So keep that in mind. If you are setting up your accounts receivable, say like in QuickBooks, there are options to go in there and say, once accounts reach X amount, start charging interest of whatever interest rate you want to do. Now, remember, each state has set rates that you can't go above for the usury rate. So don't get too wild and crazy on that. That could, come around and bite you in the posterior on there. So make sure you understand what the rates are in your state. But this is a good example as to if you have accounts receivable sitting there and building up, that's really cash that you can't get, that you're going to have to probably pay interest on, because keep in mind, you still got to fund your operations. You got to still get everything, but you can't get the cash out of there yet until they pay you. So, and then another aspect is, and this goes more into cash management, is how much days in AP do you have? If this case, we said we had 30 days in AP. Well, what happens if we add just 10 more days? Instead of doing 30 days, we don't pay until 40 days. Well, almost took, took quite a bit of about 15,000 off your daily cash needs. So that's another cash management tool that you can consider as you're doing this. But again, we're doing this to figure out how much you need for your line of credit. So when you're filling this out, go through and calculate, how many days is in your AR. If you have inventory, do that calculation, and then how quickly do you pay your accounts payable. And this is on average. And once you do that, then you have your number as to, okay, when I'm applying for a line of credit, this is what I'm going to need. And what I would suggest is when you meet with the banker, you bring this template. Go ahead and complete it and bring your supporting detail. So how did you get to that number? How did you get that number? Have the supporting detail. And you can show it to them and they can say, okay, yeah, it definitely looks like you're going to need, $68,000, $70,000. So you have a stronger leg to stand on. Because a lot of times, and you're going to see as we go through this, you're going to have bankers who just go through a form or a template or boilerplate, and they don't really pay attention. If you're bringing this to them, you're going to have a stronger leg to stand on to explain to them what you need. So let's go ahead and go back into the presentation. So when you're researching banks, now there's many banks out there that offer lines of credit, and when we're talking about lines of credit, I'm specifically talking about business lines of credit. Now, there's bunches of banks out there. You have Wells Fargo, US Bank, you've got your local banks, which I suggest you maybe consider them first as you're going through this process. But make sure you research, what are their minimum requirements. You have to be in business for 6 months or a year, or you have to have minimum sales of 25,000, a million, whatever their minimum requirements are. So when you're going through, try get an idea. And a lot of this stuff is going to be posted online, so you can be able to research and kind of compare to the banks that what do they offer. And you don't have to necessarily pull a line of credit from the bank that you currently work at, or currently bank at. However, a lot of times they want you to already have a checking account there. So it may be one of those situations where, let's say you bank at US Bank, but you want one of the lines of credit over here at Wells Fargo. Well, you might have to set up a checking account over there as well. So keep that in mind, as sometimes that is one of the aspects there. Interest rates. And in particular, obviously you want the lowest interest rate you can get, but how are they calculating their interest rates? Are they calculating it based off of prime, 2 plus prime, or are they doing it at the LIBOR rate? How do they calculate their interest rates? Payments. How often do they say you have to make a payment? They're going to charge you interest monthly when you do draws, but how often do you have to put in a principal payment on the respective lines of credit? And access to draws. How quickly can you have access? Is there like a 1, 2, 3 day waiting period before you can pull on the line, or is it immediate? Can you do it electronically? You're sitting at your computer, and can I immediately pull it out? And then renewal options. So if your line of credit, most lines of credit are going to be 12-month line of credit, and you have to renew every year. Some are 18-month, and some I have seen some that were 2 years, but those were for bigger companies that had a lot of established credit with a particular bank, and they had a lot of liquid assets, so they were able to get a 2-year line of credit. Now, interest rate. Most lines of credit will either have a fixed or variable rate. The variable rate will usually be dependent on some sort of base. A lot of times either the prime rate or the LIBOR rate. LIBOR rate is the London Interbank Rate, and it will be stated in ways such as 2% over the prime rate at the time of the draw, or something of that nature. So if that's what the rate says, then for a variable rate, then make sure you do a calculation real quick. And I would even look back historically what the base has been. So if they're using prime rate, look up the prime rate for the past several months. Has it been creeping up, or has it been kind of consistent? Same thing with the LIBOR rate. Has it been creeping up? Has it been consistent? And you could just do this on Google. You can just go Google search it, and it'll bring it up for you. But if you do get a fixed rate, it'll usually be noted at the top of the loan document. So most banks, they'll give you a line of credit document, and a lot of times at the very top, they'll list out, the available credit. That's how much you can draw on it, and then there'll be some other descriptions, and then there'll be a box that'll say what the interest rate is, and so that's where you'll find that. But again, you want to research this. Like all of us, we want to save money, so you want to try to get the lowest rate that you can possibly get. With obviously the most that you can borrow. So just keep that in mind when you're looking at the rates, that sometimes they are variable. Now, renewal. Most lines of credits are for 12 months, like I indicated, and at the 12 months you need to submit some sort of financial information to the bank to keep that to get the line of credit renewed for another year. Now, some go longer, some go to 18 months. Not all banks will offer that, and especially if it's the first time you've pulled one, they might not offer you the 18-month. They might just do kind of a trial 12-month line of credit. But the biggest thing you want to make sure is that your line of credit doesn't renew in your busy time. So in this instance, I just went down and said, if your busy time is going to be September through April, you're cranking out stuff before winter time and all the way through winter, and then as winter ends, you start to slow down. Do not have your line of credit renew 2 months before, 2 months after that busy time. I know that might sound odd, but a lot of times you're ramping up for that time, and you're ramping, and then after your busy time, you're kind of decompressing and catching up on a lot of the miscellaneous admin stuff that you didn't do. So if you can avoid it, obviously avoid your busy time at all costs, because you do not want to have to be trying to renew your line of credit while you're slammed, getting products and services to customers. You want to make sure it renews at a reasonable time for you. And if you can avoid too close to that busy time as well, either on the front end or back end, I would suggest that as well. But again, if you can't avoid that, at least avoid having it renew in the middle of your busy time. Because remember, when you renew, you have to submit financial data, either a tax return or income statement and a balance sheet or a cash flow, or depending on what they want you to have in that renewal. So that's going to be a lot of stuff that you'll have to bring to the forefront, again, while you're slammed with this. So try to make sure that your renewal is not when you're going to be slammed with work. Now, payment terms. Obviously, make sure you understand the payment terms related to your line of credit. Some lines of credit require full payment within the line of credit within a 12-month period. Additionally, I have seen some that require you to rest the line of credit for a specific number of days, such as 30 days. And what that resting means is you can't pull on it for 30 days. In particular, I've seen this on service organizations that have that. Again, it's because they have a lot sitting in their AR and they're not collecting on their AR, and so they're having to pull on their line of credit a lot. But I have seen banks that say you must rest your line of credit for X amount of days during the 12-month cycle or 18-month cycle. Just keep that in mind. If that requirement is in there, make sure you look at your financials and say, okay, if I have to rest it, what is the time of the year that it's best to rest it? Because I've collected most of my AR. I don't have a whole lot of expenses going on, let's say August or whatever time. Just make sure you go through and you calculate that, because you don't want to just blindly sign your line of credit and that term is in there, and all of a sudden you're needing to draw on it and the bank's like, no, you have to rest it. They don't necessarily say when you have to rest it, but you will have to. And again, I don't see this all the time in lines of credit, but just be aware that that is one of those terms and one of those criteria that come up that could impact you. And interest will always be due monthly. Keep that in mind, especially if you're drawing on a significant sum and you won't be paying it back for a couple months. Another aspect with interest is to keep in mind is when you pay, let's say you have a line of credit and you've got $30,000 draw on it, and at the end of May you pay off that $30,000. Well, in June you're going to have another payment of interest, because interest is being accrued daily on that line of credit. So don't be surprised if you get a bill or invoice or automatic payment taken out of your account in June from the bank because of interest. And so just keep that in mind, is even though you paid it off, there's probably going to be accrued interest there. Now, the other thing that I will highly suggest is whoever you bank with and you have a line of credit, have them indicate to you, preferably in writing, what your accrued interest is as of the day that you're paying off the line of credit, so that you at least understand how much you have, and in particular have them give you the calculation. So if they say you had this $30,000 outstanding for 15 days at 6% interest, here's the calc, so that you can go through and make sure that you agree with that. Again, we don't want there to be surprises. Nobody likes surprises, and so making sure you understand what is there and how much you're going to owe the following month after you pay it off. Now, financial covenants. Now, this is where a lot of people run into trouble because they don't realize their financial covenants in their line of credit, and they don't realize what those covenants mean or how to calculate them. Now, some of the most common ones: debt to equity. I mean, that's literally what it means. Is you go to your balance sheet and you say, how much debt do I have, how much equity do I have, and divide those into one another. And usually what I've seen is they want your debt to equity obviously to be below 1. Now the reason being is if the ratio is above 1, what that says is you have more debt than you have equity in the company. And so that's why they want that number to be below 1. And so keep that in mind, is that's a very, very common one to see in the covenants. Current ratio and cash ratio. They can set certain criteria on the current ratio. They want a 1-to-1. So remember the current ratio, current assets divided by current liabilities. They want at least the current assets to cover all the current liabilities. So that is one of the parts in that covenant or in that calc. Important thing to consider if you have the current ratio sitting in as one of your covenants. Does the bank include your draws as a current liability? So if you have your line of credit and you take a $30,000 draw on your line of credit, is that $30,000 added to the current liabilities on your calculation of your current ratio, or can it be excluded? So make sure, if it says current ratio in there as one of your covenants, make sure you get clarification from them, because obviously as you're coming up on your renewal or as you're going through your financials, if you're seeing that, hey, with the draw I'm going to be out of compliance with this, how do I need to adjust it? Or if it's excluded, that makes it easier for you to focus on the items you can control in your current ratio. Now, the next item. Now, these items that we're going over, when you're taking out your line of credit, especially if you're a new business or you've only been around for a few years, you're probably going to get a junior banker who's going to kind of fill this stuff out or work with you on this. Now, I don't mean this disparagingly, but a lot of times junior bankers are told by their supervisors, click this button, bring this in, this stuff needs to be in the line of credit when you're working with a customer. Because of that, a lot of times what they'll do is they will just grab a boilerplate template for covenants and drop it in, and so they can check the box. Did you put in covenants in the line of credit? Check the box, yes. Well, I've seen many situations where the junior banker didn't even understand the covenants that were going into the line of credit or into a loan document in general. And so this is where their ignorance of what these covenants mean, and you might not understand what these covenants mean as well, where it can just become just a big thorn in your side. Now, these covenants, as I'm talking about this, the important thing to consider is if you're in violation of the covenants, the bank has the ability and usually the right to call the loan and say, okay, you have to pay right now because you're in violation of these covenants we had in place. They don't often do that. The banks would usually try to work with you because they don't want to, just immediately, take over your assets. But that is what can happen, is when you're out of compliance with your covenants, is that can become an issue with them calling the loan or, not giving you the line of credit for the next cycle. So back to this slide. Financial statements submitted on GAAP basis. Remember, GAAP stands for Generally Accepted Accounting Principles. That is a very common one, but what you want to make sure is if they're saying, they being the bank are saying you have to submit financials on a GAAP basis, how do they need to be? Do they need to be financial statements compiled by a CPA? And a lot of times they'll say by an independent CPA. Does it have to be financial statements reviewed by a CPA, or does it have to be audited? Now, a compilation is usually kind of the very base service that a CPA firm will do. And when you get a compiled financial statements, they're going to take, and put into a nice pretty form the income statement, balance sheet, cash flow, and footnotes to the financial statements. They'll sign a compilation report and give it to you, and then you turn around and give it to the bank. Now, that's going to cost you money to have that done. Now, a reviewed financial statement is one step up from a compiled financial statement. So when you get a review done, it's all the compiled financial statements plus the CPA firm will ask you a whole bunch of in what we call inquiry questions and do analytics on your financials. And so there's a bunch of work that they'll end up doing on your financials. Now that cost even more than compiled financials. And then the top one is audited financial statements. Audited financial statements again you're going to get the pretty financials. They're going to ask a bunch of inquiry and analytics, plus they are going to test your internal controls. They're going to test invoices. They're going to talk to a bunch of people in your company, and so of course, as you're seeing as we're progressing, that is the most expensive financial service you can get from a CPA firm. And so just give you an idea, an audit historically, and again, this is going to depend on where you live, but historically, an audit is about 2/3 more the cost of a review, and review is about double the cost of a compilation. So just to give you an idea, a small business can have an audit done probably, and this is just base, assuming you don't have a bunch of issues, you're talking anywhere from $10,000 to $15,000 just to have a financial statement audit. And again, if the only reason why you're getting a financial statement audit is because of your line of credit, is it really worth it? Now, you may have like $1 million line of credit, and so maybe that is worth it, to have that $1 million line of credit. But if you only have like 100,000, 200,000 line of credit, you do not want this or this in there. That bank might not allow you to say no to a compiled financial statement, but I would keep in mind, if you see these items in your line of credit, you have to understand that you're going to have to go and hire a firm to come in and put these together. And keep in mind, there's a thing that CPA firms love to do. They love to do what's called additional billings. If they go into your financials and they realize that your financials don't have everything in accordance with GAAP and all that stuff, they might charge you extra to fix your, clean your books up, to do that. So these are costs that I want you to be very aware of, that these could bite you pretty quickly if you're in a line of credit, especially if it's a smaller line of credit. Again, if you have $1, $2, $3 million line of credit, at this point, an audited financial statement's probably more or less, it's a cost of doing business. But if you're a smaller one, make sure that these aren't in there, or try to negotiate down to at least, or the best you can to get to a compiled. You'll still have to pay for it, but you won't have to pay as much. Now, other covenants that you may see: restrictions on new debt. So you may be told, okay, you can have this line of credit, but any new debt that you incur, you must get approval from us before you incur it. And sometimes that can be, you need a pickup truck for your business. Well, you can't just go down to Toyota or Ford or whoever and get the truck loan. You have to get approval from the bank. So keep in mind, that is something that can pop up in the covenants. And cash balance minimum. I've seen this before, where a client, the audit firm I worked for, had to keep, I believe it was, $15,000, $30,000 in a cash account at that bank minimum. They couldn't go below it, and so that's just a huge restriction on that. So make sure, if there is a cash balance minimum, again, you want to negotiate that down, or strike that if possible. And whatever the covenant is in your line of credit, make sure you can pass the covenant before you take out the loan. I've actually seen this where a client took out a line of credit, and literally the second they signed that line of credit, they were out of compliance, and because they were already out of compliance with the covenants that were already in that line of credit. And again, this was because you had a junior banker that didn't understand the covenants sitting in there. And also make sure you understand the covenants, and can you pass in the future? If you know cash is going to be tied up the next time it renews, will you still pass that covenant, or can you get something adjusted? Now, a lot of times on these covenants, you can get a waiver. Banks sometimes will do a waiver once, say, hey, I'm out of compliance, but that's because of X, Y, and Z, and they'll give you a waiver on that. But they don't always give you a waiver, so don't kind of use that as your one get out of jail free card, but don't think that you'll be able to consistently do that. Now, collateral. Many lines of credit are unsecured, which means there's no collateral. However, if they do require collateral, sometimes they're going to require inventory. So a certain balance of your inventory will be collateralized against the line of credit. AR factoring. avoid this if possible. A lot of times what I've seen is if AR is considered collateral, what the bank will do is make the payments come to them, and then they will turn around and send you the payments. So you don't want to have a middleman doing that collection. And sometimes I've seen it where they've had this in place and there was no end date. They just continuously did it. So if you have to do the AR factoring, for your business, make sure you put in some sort of end date. Say this is only going to be effective for the first 6 months of the line of credit or something, because you don't want to give up control over your accounts receivable collections. And then company, building, equipment, your fixed assets, try to avoid having this be one of the collateral against the line of credit, because you really want to keep those items for larger long-term loans. If you're going to do some big expansion, a lot of times you'll say, okay, I'll give you a second on my building for this large loan, so that then I can build a warehouse or something like that. So that's why you want to try to keep that. So if that building equipment is collateralized against the line of credit, it's harder to then cross-collateralize that against a larger term loan. So if you can avoid it, if it's just some equipment like some vehicles that you're not that concerned about, and it's like, okay, yeah, I'll give them the right, the first lien on these particular pieces of equipment as collateral, then go ahead about that. Draws and fees, again, some lines of credit, not many, but some do require you to take a minimum draw every year, and most are going to make you pay fees. That is just a cost of doing business. Keep in mind, this is almost like an insurance expense. If you think about insurance, is just to protect you, your company, from a cash flow standpoint. So keep in mind, some line of credits may require you to take a minimum draw. If you think about it, you take the draw, you then turn around and pay it back, and then you pay the interest on the draw. That's no different than paying a fee on the line of credit. It's just on how they adjust or how they did the calculations. Now, common pitfalls. So here are some of the more common pitfalls, and we've actually gone over several of these as we've gone through the presentation. But my 20 years of being in public accounting, some of the common pitfalls. Again, we actually just covered this particular one. I saw a client that was actually in default of their covenant the day they signed that line of credit. Again, that was just because the banker didn't understand. So when you have covenants in your line of credit, before you sign it, go do the calculation on your current financials. Where are you at? If the current ratio has to be 1 or above, current assets equal current liabilities, and if you're at like 1.001, well, are you going to be able to keep that above the 1? So that's something you definitely want to keep in mind on that. Debt to equity covenant was so restrictive the client could not pursue an opportunity. This was a very nasty one that I came across, where the client had to keep it under at a certain point, and I believe it was 0.75 or 0.5. So in other words, their equity was obviously significantly higher than their debt. Well, they couldn't take advantage of an opportunity because they would have put debt on the books, and it would have skewed their formula. And this particular bank was, let's just say they weren't the best at giving you leeway on that. So make sure that doesn't kick in. Next item, the client pulled on a line of credit for operations with no plan on payment, on how to do the payments, or understanding the draw was temporary. Remember, when you're pulling on this line of credit, this is temporary. This is because you have cash tied up with an asset that it's just a matter of collections. These lines of credit, you don't want to use this for just your overall operations, because that will put you into more or less, I don't want to be too drastic on this, but sometimes it'll put you in the death spiral in there. Your line of credit really should just be temporary because you have cash tied up. You have cash coming in, it's just tied up somewhere. So definitely strongly keep that in mind on there. The AR was factored. Again, the AR collections went to the bank first and then to the client. Again, somebody else is controlling your receivables, and then they are, quote, deciding when to send you your own money. So yeah, that was not a good situation. So yeah, keep that in mind. Renewal terms were during their busy time, and they lost sales. Again, in this particular situation, the client had to have reviewed financial statements submitted to the bank, and the bank was not going to renew it until they got reviewed financials from a CPA firm. Well, if you're working with a CPA firm and the firm says, hey, I need all this information to put these financials together, well, you've got to go and take your time to do that. Then in this particular situation, the client wasn't able to get some of the information to the firm. Well, the firm can't finish until they get the information, so it just became this quagmire, and they ended up losing sales because they had cash tied up in their accounts receivable that they couldn't utilize, and they were trying to get their line of credit done, and this was all happening during one of their busier times. So again, like I said, make sure that that you fully understand when your busy time is and when you need to have a line of credit. And then lastly, the client applied for their line of credit when they needed it. Now remember, when you need a line of credit, it's difficult to get it if you don't already have one. But you want to apply for one when you don't need it. Because when you need it, that's when you have, again, cash tied up, or you may be having, some of your ratios might be a little skewed, and the bank at that point in time, one, if they know you need it, they have the leverage. They have the negotiating power over you. And so that you don't want that. You don't want to give anyone power over your company. And also you don't want to be scrambling trying to somehow come up with cash. Because if you do wind up in that situation, then the best recommendation I would say is, first I would see if you can do a capital call. Don't give somebody negotiating or leverage over your company. You don't ever want to do that, because that just that's no fun for anybody. Nobody wants to have that. So I hope this has been helpful for you as you go through and you start doing negotiations for your particular line of credit for your company. And again, utilize that template. That's a great template actually for you to, if you're not even going to get a line of credit, it's a great template to use to see how much cash you have tied up in your receivables. How much cash do you have tied up in your inventory? So it's real simple to use. And again, as you use that template, like I always recommend for all the templates, make a copy. Keep one as a master copy so that you can play around with another one. And if you happen to break something on that, you at least have the master copy to go back to. So again, I hope this has been helpful, and the best of luck when you're getting your line of credit. And remember to, if you go through this, to make sure you have everything you need to make sure that you have the leverage when you go into your respective bank. And with that, I bid you good day.